Welcome to this explainer. Today, we're diving into the ultimate wealth-building showdown, index funds versus individual stocks. Honestly, this is kind of one of the most defining financial decisions you will ever make. So we're going to break down the data to see where you should actually be putting your money to build real, lasting wealth. Let's get right into it. Okay, so put yourself in the driver's seat for a second. Imagine you have exactly $10,000 to invest right today. You are basically standing at a major fork in the road. Down one path, you use this money to buy shares of specific individual companies, hunting for the next Nvidia, Apple, or Tesla. Down the other path, you put every single penny of it into a broad index fund and just buy the entire market. So which one actually wins? It's the classic investing mystery. One path promises the absolute adrenaline rush of high-stress stock picking where, hey, you might hit a home run and strike it rich. The other, it's the boring, reliable, totally hands-off index fund route. Let's uncover which strategy actually puts more money in your pocket over the long haul. All right, let's dive into this. Section 1, the individual stock gamble, high risk, high reward. We've all seen the myth constantly pushed on social media, right? That finding the next big tech unicorn is the fastest and literally the only way to get rich. But listen, buying individual stocks means you are tying your entire financial outcome to a single point of failure. Imagine pouring all your life savings into one airline right before a global pandemic hit, or, pouring it all into a popular retail company just months before it filed for bankruptcy. Individual stocks absolutely offer unlimited upside, for sure, but your success hinges entirely on a handful of executives making perfect decisions. For every investor who picks a massive winner, there are countless others who lose their shirts by choosing the wrong companies.
Let's pivot to the second choice. Section 2, the index fund advantage. Betting on the entire economy.
So instead of gambling on a single executive board's decisions, an S&P 500 index fund lets you own shares in America's 500 largest publicly traded companies all at the exact same time. The mechanics here are just beautiful in their simplicity. As you can see, you aren't just betting on one lucky winner in the corporate race. You are betting on the continued growth of the entire United States economy.
500. Think about the sheer scale of diversification that number represents. It is your absolute greatest shield. With 500 companies, if a few have a terrible year, or a disastrous product launch, or even go out of business entirely, it doesn't wreck your portfolio. The remaining hundreds of companies simply absorb that loss, and they just keep driving your overall wealth upward. Let's look at this side by side. Section 3, Investor A versus Investor B. The persona face-off. We're going to track exactly how these two distinct strategies unfold over decades. Just consider the stark contrast in their daily lives. Over here, Investor A spends their weekends buried in earnings reports, glued to financial news, constantly trading, and honestly, they're highly stressed out. Meanwhile, Investor B, they simply automate a monthly transfer into an index fund, totally ignore the daily market panic, and completely avoid making emotional decisions. And here is the massive plot twist the data reveals after 20 or 30 years. Investor B often ends up with equal or even better returns. It turns out that in the world of investing, sometimes doing absolutely less actually earns you a whole lot more. So let's dig into the why behind that success. Section 4, Risk, Diversification, and Costs, the silent wealth killers. Think of the hidden mechanics like this. Imagine owning just one single restaurant. If the local economy slows down or, say, a really bad review hits, your income suffers immediately and severely, right? Your risk is entirely localized. Now, flip that. Imagine owning a tiny fraction of 500 different businesses. You trade that one single point of failure for an incredibly robust, market-wide safety net. Because look at this breakdown. You aren't just diversified across 500 individual businesses, you are diversified across entire sectors. Technology, healthcare, banking, energy, consumer goods, manufacturing, all at once. If the banking sector takes a hit one year, while your healthcare and tech holdings are right there balancing you out, one company's or even one entire sector's problems simply will not threaten your entire financial future. And then we got to talk about the costs. Constantly buying and selling individual stocks generates massive tax burdens and trading fees. By contrast, index funds, particularly low-cost exchange-traded funds, charge incredibly small annual fees. Over decades of compounding, saving just a tiny fraction of a percent in fees literally translates into tens of thousands of extra dollars staying right where it belongs, in your pocket, instead of, paying for a fund manager's new yacht. So where does that leave us? Section 5, your winning strategy, the hybrid solution.
Now, we absolutely have to acknowledge the incredible, life-changing upside of getting in early on a revolutionary company like an Apple or an Amazon. We can't be dismissive of that. Because of this, financial experts actually recommend getting the best of both worlds through a hybrid approach. And this brilliantly illustrates that recommended strategy. For a smart path forward, allocate 80 to 90% of your money into index funds as your steady, reliable wealth builder. Then, dedicate that remaining 10 to 20% slice of your portfolio to carefully selected individual stocks. This strategy keeps the vast majority of your money deeply protected while still satisfying your craving for excitement and the potential for a massive stock pick win.
The investors who succeed aren't always the smartest. They're often the most patient. Building wealth really isn't about being some financial genius who finds the single perfect stock before anyone else does. It is about consistent, patient investing over a long horizon. It's about letting time and compound interest do all the heavy lifting for you.
So, what does this all mean for you? The real question is, what is your first step toward financial freedom today? Whether you choose the pure index fund route or that hybrid approach we just outlined, the absolute most critical thing is getting started. Don't wait around for the perfect moment. Take action and start making your money work for you today. Thanks for joining me for this explainer, and happy investing.